Hey, Kyle, thank you so much for joining us. For those that don't know, Kyle is the founder and chief investment officer of Quest Capital, and he is the manager that we utilize on many of our investment strategies. So thank you for joining us today. Could you start by telling us where are we with our stock market today? What's going on from your viewpoint?
Hi, Michelle. Yeah, thank you for having me. I appreciate that. The simplest way is to kind of jump into a chart to kind of put things in perspective because nowadays we're hearing a lot of buzzwords kind of about inflation and recessions. And I think it's important to realize that there is not a perfect correlation between recessions, inflations, and what that means for the equity market. So I kind of like to take a step back and put it in perspective for us. So
Okay.
I'm gonna bring up a chart here. This is the S&P 500 back to 1955, and you'll see a green and red line that is a 50-month moving average. So it's a very long-term perspective of the overall equity market. And I always like to take a look at something like this when the short term feels a little uncertain and just to be able to help understand where we are, what a pullback in the equity markets really means for the bigger picture, which is what most people are really concerned about. So here we have the S&P 500, and on below we have the distance from that 50-month moving average. So when the area chart is above the zero threshold, we're above that 50-month moving average. When it's below, we're below the 50-month moving average.
Understood.
And so what we had in the past is the severe bear markets, and I look at bear markets as something that takes on typically a 40 to 50% loss in the market, and it usually lasts 4 to 6 years. And we've only had a handful of those in history. I don't look at bear markets as just an arbitrary 20% figure that you'll sometimes hear. And when we look back in history, we have four bear markets from my perspective since 1955, and that includes like a 2008, the dot-com bubble, 1973 and 74, and 1969. And those areas, we came below that 50-month moving average and we stayed there for a while. So this is a quick snapshot of looking at past bear markets and how they are compared to today. Because today we still remain above this this long-term rising trend. So at this point, I still think it's too early to be able to say whether we're in a protracted bear market that could take over for the next 3 to 5 years, or if this is just a more intense correction, which at this point it's too early to say, but some of the factors I think lean more towards this just being maybe a bigger correction that may take a little time to unfold. But we still remain in this long-term upward trend, and we'll have to see where things go over probably the second half of this year. I think will be very telling.
So I understand what you're saying from a 50-month average, but the news out there is so bad. Why are you feeling that it's too soon to indicate that it might drop below the green line?
Well, let's take a look at just this year so far. And what we have here is the S&P 500 over the last close to 2 years. And these white dotted lines here form what's called a bullish wedge. And so the likelihood that that the market drops off into something severe to the downside is very unlikely, simply because so far this year, this has been a very clean technical pattern. And right now, as we see some positive divergence in another technical indicator that we follow, which is called the relative strength index, this pattern, along with a positive sloped relative strength, leads me to believe that in the near term, we are more likely to rally higher before a more severe decline were to happen, if that even does unfold. And right now, I'm kind of looking at two different options as potentials for the next 2 months or so, which is one, we can either just break out of this, and then, or two, we sell off and then eventually we break out. But either way, I think we need to break out of this wedge pattern. And we have found support at that lower trend line over and over. And we've had resistance at the upper. But as time goes on, this filters down into a tighter and tighter channel that needs to be broken out of eventually. And I favor one of these two scenarios playing out.
Where does volatility fit in with all of this?
Well, the VIX is what I like to follow, which is the S&P 500 volatility index. And this is actually a little more positive for the overall market. Typically, when we see equity prices selling off, the VIX starts to spike. So back here we have this was during the COVID crash, and the VIX spiked and took off. Here we have a series of lower highs, and that means that while the S&P 500 was making lower lows, the VIX was making lower highs. If there was substantial underlying fear within the market, you would expect to see this spiking up. And so volatility as a whole has been a little more tempered than maybe some realize. And so I think this is a pretty positive outlook. If we start to see this break out to the upside, well, then that's something different. But for the past, basically this entire year, we've seen a series of lower highs in this, and that's the conducive to less volatility within the markets.
That seems to make me think about investor sentiment when you said they're lower highs. What's going on with investors as a whole? How are they feeling today in today's market?
Well, we have seen some of the most extreme environments for investor sentiment in history. This is the AAII net bulls minus bears. So it's looking at how many investors out there are bullish versus bearish. And so we have investor sentiment back to 1988 here on the top, and we have the S&P 500 on the bottom. And what you tend to see is in very low sentiment areas is where you actually get market bottoms. These extreme spikes to the downside, this is like March of 2009, where the market bottomed at the bottom of the global financial crisis. We have not had investor sentiment that was this dire in quite some time. There were some metrics that looked like they went back. We had some of the least amount of bullish investors in 30 years or over 30 years. And so investor sentiment is quite low, but that actually acts as what's called a contrarian indicator sometimes, and it can point to a more positive outlook for the market.
Got it. So I understand with investor sentiment really low, could that be because there's fear with inflation that the Fed's continuous rise in interest rate might cause problems for the economy as a whole?
Yeah, definitely. But one of the biggest factors, the Fed is in charge of controlling inflation, but also unemployment is a key metric for them. And so you have an unemployment rate that's essentially been rock bottom, which is great for the overall economy. And this is something, for things to get really bad in the overall economy, I would expect this to have to start moving up pretty substantially. This blue line is the unemployment rate, and currently we're at about 3.5%, which is indicative of a really strong overall economy.
Well, where is inflation? Our inflation numbers came out today. What are we looking at with
Yeah, so we had CPI come out today. It was a 40-year high. It came in at about 9%. There's a lot of cross currents that are impacting inflation right now. Everything from energy and Russia-Ukraine war and that impact on energy prices and grain prices, uh, oil, and but we also have supply chain issues, which are expected to lighten up over time. We have central banks monetary policy that has impacted this now since the COVID-19 pandemic. And so while we had a substantially higher, a higher than forecasted inflation figure today, well, we also had the S&P 500 and all the major indices do relatively there was a very modest pullback. Less than the S&P 500 was down less than 0.5% today, which last month's figure when we had a hotter than expected inflation figure. S&P pulled back about 8 or 9% in the matter of 3 days. So now, will be interesting to see what happens tomorrow. But what I'm saying is, when we got this higher than forecasted inflation number today, markets actually responded somewhat, favorably. Maybe not favorably. They weren't excited about it, but they were not as scared as they have been in the past. And I think one of the reasons for that is, as I mentioned, is the stock market is forward looking. On average, you can kind of think of it as looking for it's anticipating what's going to happen in the next 6 to 9 months, whereas inflation is looking backwards. Recessions tend to be nailed down after the fact. And so when you look at some of the assets, I'm going to show a couple of them here. When we look at industrial metals, which plays into inflation, we've had a substantial pullback in some really key inflation assets. And so this includes aluminum, copper, lead, nickel. And it's had over a 30% pullback. And so I think things like this, the market's seeing these pullbacks and realizing that these higher than forecasted inflation figures are gonna have to likely settle down. You also have lumber prices down 45%. We've got agriculture like wheat and corn and soybeans down over 20%. And then natural gas has pulled back substantially along with oil. And so all these factors, it may take a little time to play out, but these are some of the key components that are going to impact the overall picture for inflation. And I think markets could be realizing that now and maybe taking these inflation figures to be not quite as extreme when thinking about where we are 6, 9, 12 months from today.
What I heard you say is, because of these pullbacks, you're anticipating the year month after month change to not continue to keep going up higher.
Yeah, these are all signs of inflation potentially peaking. Now, when you look at something like this and you look at oil and where it's come since the pandemic low, this is a long trend higher. This is a couple years of oil moving higher. Same with the majority of the other asset classes. And so that doesn't mean that next month necessarily that inflation figures are going to drop off. We don't know exactly where they're going to peak, but what this does show is that it's unlikely that they're going to continue to rise in an elevated fashion for a whole lot longer. I would expect to see those start to tip over a little bit as these prices kind of come back down a little bit.
As a whole, as you look at all the charts and information that you shared with us, what would you think is the reason why our stock market is experiencing such difficulty this year?
Well, I think it really actually comes from a place of coming too far too fast. The returns post COVID have been some of the strongest 2 year pockets of time that we've ever seen. And markets don't like to get disconnected from the mean. And that's why I like to show that 50-month moving average. It wasn't necessarily that the market was due for a 20-25% correction uh, based on what's happening in the economy today. I think it's a lot of it has to do with technicals, which is why we follow it so much. Is that when you start to get pulled away from the moving averages, they want to reconnect eventually, and we're seeing some of those reconnects, and it's just a nice healthy, at this point, a nice healthy reset for the overall market. I think we'll see where we're at in the next 6 months will be really important for the bigger picture, and I have a feeling by year end we'll likely know, is this the start of a major bear market, or is this likely to more so just recover over time?
Got it. Thank you, Kyle. That's really helpful, and it definitely paints a very clear picture of what we're waiting to see. So I appreciate your time. Thanks very
Thank
much.
you. Appreciate it.